Hey guys, thanks for coming back. We're going to take a look at a few charts of the SPX this morning and look at some of the pinning that's going on in this market. So the white line at 4960.51 is the 7-day one. So if you look at your bell curve and you look at the option expiration, the 7-day, the weekly option is a pretty standard option, and the moneyness timeline for market makers, they trade, you know, daily options, 7-day, 14 days, 21 days, 30 days, you know, they go up the moneyness like that. So we can do the same thing. We can look at where these distributions lie. And the 7-day one, 1, 2, 3, the one is at 49.60, and that represents 68% of your risk. And so that's what they like to use for their risk. They use that inside the one. So going from the mean to the threes, 34%. Going from the other side, mean to threes, the other 34%. 34, 34, 68. So there's your 68%. And you can see that's where they have been pinning the market for the last 3 days at this 49.60 level. If we break it, we run right into trouble really quick. 49.71 is a orange line. That's a 3. It signifies to me that I'm looking at a 3. So that is a daily 1 period 3. Then we run into this white dash line. That's my 8 period 1. So why do I do 8 days? 8, not 8 period, I'm sorry, 8 days. We have to distinguish between periods and days. 8 days is when your options start on Thursday. I don't know if you knew that. For the weekly options, they open the ticket on Thursday and they go through the next Friday. So that's 8 days. So I run the 7-day to the 8-day and get that little spread there, and I think that's what they do the same. And so very interesting. And then we have a 7-day 3 parked right on top of it. 1 period. Try to make all of these dash lines to tell that they're 7 days. So we've got this huge amount of resistance protecting this purple line. 5015 is that JHEQX, the JP Morgan call collar, and 5,000 is what the traders want. So they're threading the needle here to keep people off of that line. And they have not moved their risk yet. So we might get a pop and drop, or we might get, a breakout and they run with price like they did last quarter, where they just hedged it and started making money. That's why the market flew up higher at the beginning, and then the repo market jumped in and sent it skyrocketing. But I don't think they're going to do it twice in a row. I just don't, get the feeling that they're going to do that. So, we have not had a correction in a long time. So what we need to be doing is like taking 5,000 as a benchmark and just start taking, um, what is, 10% off of 5,000. That would be 4,500. What is, 20% of 5,000? And that's 4,000. So you get your ideas of where they're going to start coming in. They're hedged long to take these dips of 5, 10, 15, 20% corrections. They stay long. They don't sell every time the market pulls back 5, 10, 15, or 20%. They've got delta neutral positions, and that's why they rely on JP Morgan, right? They buy these funds to keep them delta neutral. And so as long as it stays under 5015, they don't care where it is inside that range. right? They don't care at all. And I used to have my levels on here. Apologies. So they have a put, um, and then a short put, long put at the bottom and a short put at the top. So, or I'm sorry, short put at the bottom and a long put at the top, in the middle. So we just trade within their realm, and if that makes sense. And just be aware that we're at the top. I mean, this is the top. This is the tippy top. We're 30 points away from 5,000, or I guess in ES we are, in SPX we're 50 points, but I don't think they're going to touch it. Um, let's see, in 5 days, you can see it even gets worse. There's a bunch of resistance here, and 7 days, resistance, resistance, resistance. So they have a lot of levels to tuck their pins. Um, 10 days, more resistance, and a target. So I just don't think they're going to let you up there, is what I'm trying to say. And if they do let you up there, it's going to be very brief, short lived. It could be a touch and flush. So just be aware that we've got a lot of resistance. The delta hedging position is what I'm really interested in because my indicator is perfect for that. We can get spreads over these time periods. So if we want to do an 8 day spread or a 7 day spread, or, we can tell where our threes are very easily and where other cheap risk might be to lend us a hand. So we could, follow and act like the dealer, lean on the cheap risk, and then if it rolls, we know where to manage our position to move it out, and move the other side up. So I'm going to be doing a lot more of option delta neutral positions going forward, mainly because I think the market is going to stay sort of flat all year. We're not going to sell off. Growth, is evident. They're pushing the economic growth higher in the numbers. So, um, it's an election year. I just don't see the market tanking. And so going delta neutral might be a very good strategy. And I will start um, sharing some delta neutral positions. I like the short strangles myself because it is the time for the Greeks are irrelevant. It doesn't matter what your delta, gamma, theta, vega are. You close inside the line one tick and you keep the premium. So they are naked strangles, short strangles. So you have to be very careful to adjust the position should the side get challenged. But they're, we could create a condor or something like that very quickly. All right, guys. I'll be doing a lot more of that and looking forward to it. And hope y'all have a great day. And just be aware that, we are in a lot of resistance trying to get up to the target. It's not going to be a cakewalk getting up there by any stretch of the imagination. Y'all have a good day, and we'll see you later.